The average actively managed mutual fund in America charges you 1.2% per year in fees. The Vanguard S&P 500 Index Fund charges 0.03% on $200,000. At 7% annual real return over 30 years, that difference doesn't cost you $20,000. It costs you $370,000. In compounding, you never received, taken silently, automatically, before you ever noticed it was happening. And here's the part that turns it from unfortunate to darkly funny. 9 out of 10 of those expensive active funds still underperform the cheap index they're supposed to beat. They charge more. They deliver less. This has been documented publicly for 40 consecutive years. Billions of dollars continue to flow into them every quarter. That's not a conspiracy. That's incentives. The fund manager gets paid whether you win or not. You're funding their escalator while you take the stairs. Which brings me to everything this video is actually about. I spent a decade in banking, then another decade running my own business, surrounded by accountants and tax lawyers who talk about money the way most people talk about the weather, constantly, casually, without drama. I have multiple hundreds of thousands of dollars invested right now. This is not theory. Today, I'm going to give you the framework I actually use, the math that actually matters in early 2026, and the psychological traps that will cost you more money than any market crash ever will. None of it requires a Bloomberg terminal, a financial advisor, or a working understanding of options Greeks. By the way, I built a free early retirement calculator because most online ones are mathematically wrong. It uses BlackRock and Vanguard logic to expose the weak points in your plan, and I only ask for your email to send the report so I don't store any of your financial data. Link is in the description. Now, everything I'm about to tell you returns to one single idea. The market is an escalator. Not a rocket ship, not a slot machine, an escalator. It moves upward, slowly, mechanically, with occasional breakdowns that terrify everyone standing on it. But over any 20-year window in modern financial history, the S&P 500 has gone up. Through the Great Depression, through 2 world wars, through the stagflation of the 70s, through the dot-com implosion of 2001, through 2008, through a global pandemic that shut down the entire physical economy. 10% annually in nominal terms since 1926. 7% after inflation, the escalator goes up. The entire game, the only game, is staying on the escalator long enough for the math to work in your favor. And the entire financial media complex, the entire active fund management industry, the entire culture of hot tips and market timing, and this time is different. All of it exists to get you off the escalator. Not maliciously. There's no business model in telling someone to buy a low-cost index fund and ignore it for 20 years. Boring doesn't sell ads. Boring doesn't justify a 1% management fee. So the escalator keeps running, and the industry keeps inventing reasons to panic in the stairwell. In a few minutes, I'm going to show you exactly how much money that panic costs in real dollar terms. But first, here's why the fee problem is even more broken than you think. And it starts in a place most people never look. Most people with a 401k through their employer have no idea what they're actually invested in. They clicked through an onboarding screen 6 years ago, picked something called Balanced Growth Fund or Target Date 2050, and haven't opened the account since. The expense ratio, the annual fee taken automatically, regardless of whether the fund makes money, is running in the background right now, compounding against you every single day. The average expense ratio on an actively managed US equity mutual fund is around 1%. The Vanguard S&P 500 Index Fund, VOO, charges 0.03%. That's $3 per year on every $10,000 invested versus $100 for the same balance in an active fund. Sounds like a rounding error. Run it over 30 years. Say you're 35. You have $50,000 saved and contribute $500 a month going forward. At 7% real annual return in a fund charging 1%, you retire at 65 with approximately $740,000. The same contributions and market return in a fund charging 0.03% gives you approximately $960,000. Same market, same person, same contributions, different fund. That $220,000 gap didn't go to your retirement. It went to a fund manager who has almost certainly underperformed the index they were supposed to beat. That's not me being dramatic. The S&P Dow Jones Indices SPIVA report, published annually, peer-reviewed, tracking active fund performance against benchmarks, found in its 2024 release that over a 20-year period, approximately 93% of large-cap active funds in the United States underperformed the S&P 500. 93%. You paid a premium, you got a discount. The escalator kept going at the same speed regardless, and you handed someone $220,000 for a slower ticket. The fix is almost offensively simple. Go to every account you have, 401k, IRA, brokerage, and find the expense ratio on every fund you hold. Anything above 0.1% in a broad market fund is costing you, compounding you didn't agree to give away. Switch to the lowest cost equivalent available in your plan. One action, guaranteed positive expected value. The highest return per hour activity in personal finance. Now, before we get to the behavior that costs even more than fees, and it costs significantly more, I want you to meet Marcus. Marcus is 42, smart guy, successful career in supply chain management, $130,000 a year. Unlike most people, he actually started investing properly in 2015. He opened a brokerage account, put $30,000 in a diversified equity fund, set up $800 a month in automatic contributions, and told himself he was in it for 20 years. Textbook escalator behavior. Then, February of 2020 arrived, the S&P 500 dropped 34% in 33 days. The financial media was predicting depression-level outcomes. Marcus watched his account drop over $40,000 in 5 weeks. In late March, he sold everything. He didn't want to. He told himself he wouldn't. But the escalator was shaking violently, and every rational signal in his body told him to get off. The S&P 500 hit its COVID low on March 23rd, 2020. By December 31st of the same year, the index had fully recovered and hit new all-time highs. The entire catastrophe on a 20-year chart is a minor bump. If Marcus had stayed on the escalator, the worst moment of his investing life would have been invisible in hindsight. Instead, he locked in a real loss, waited on the sidelines, trying to find the right re-entry, bought back near the top in late 2021, and rode the 2022 rate hike sell-off down another 20%. Marcus did not make dumb decisions. He made completely human decisions. The problem is that markets do not reward human instincts. They reward the absence of human instincts. We're going to come back to Marcus. His story has a second chapter, and it resolves in a way that makes the whole thing worth telling. Okay, so here's what everyone building their own strategy gets wrong, and the data on this is brutal. Stay with me, because this next part changes how you think about risk entirely. By the way, hit subscribe if you're getting value here. Otherwise, YouTube's algorithm genuinely may not show you my videos again. JP Morgan Asset Management publishes an annual report called Guide to the Markets. In the 2023 edition, they tracked a $10,000 investment in the S&P 500 over 20 years, from 2003 to 2022. Stay fully invested for all 20 years. $10,000 becomes approximately $64,844. Miss the 10 best days out of 7,300 total trading days. $10,000 becomes $29,708. Miss 10 days out of 7,300. Lose more than half your total gains. Here's what makes that number genuinely merciless. 6 of those 10 best days occurred within 2 weeks of the 10 worst days. The biggest single day gains happen right after the biggest single day crashes. Which means if you sell during a crash, which is the only emotionally coherent response to watching your portfolio drop 20%, you are statistically near guaranteed to miss the recovery. The act of protecting yourself destroys the outcome you are protecting. You think the problem is picking the right investment. The problem is not selling the investment you already picked. And this isn't a theoretical failure mode. The research on actual investor behavior shows that the average retail investor earns 2 to 3% less per year than the funds they hold. Not because they picked bad funds, because they bought after markets went up and sold after markets went down every year, consistently, despite knowing the rule. This gap between what a fund returns and what the average investor in that fund actually earns has a name: the behavior gap, pioneered in the research of behavioral economists Shlomo Benartzi and Carl Richards. It is real, it is large, and it is entirely psychological. On $200,000 over 25 years, a 2% annual behavior gap costs approximately $330,000 of terminal wealth. $330,000, not from bad investments, from good investments sold at bad times. The escalator was going up the whole time. You just kept stepping off. Now, here's a thing your financial advisor probably never said out loud. Trading more is not a path to better returns for retail investors. A 2020 study in the Journal of Finance analyzed over 60,000 individual brokerage accounts and found that the top 20% of traders by activity underperformed the bottom 20% by more than 7% annually after transaction costs. The most active investors had the worst net returns. Conviction and effort and screen time were negatively correlated with outcome. This is not an argument against learning. It's an argument for honesty about expected value. Imagine a guy at a party confidently explaining why he rotated out of tech into commodities in October and then back into tech in December. His total return for the year, -4%. The S&P 500 was up 18. He tells you this story and genuinely believes his process was sound and the outcome was bad luck. It wasn't bad luck. It was the behavior gap introducing itself in person. Now, there's something specific to 2026 that I haven't mentioned yet, and it changes the noise calculation in a way that matters. The volume of financial opinion available to you has reached a new extreme. Between financial, social media, Substack newsletters, AI-generated market commentary that can produce 10,000 words of conviction on any investment thesis in 40 seconds, and a 24-hour news cycle that measures engagement in minutes, the marginal piece of financial content you can consume now has approximately 0 expected value, possibly negative value if it changes your behavior in a way that takes you off the escalator. I run an investing channel. I'm aware of the irony. The point is to use information to set your system once correctly and then consume the minimum necessary to confirm your system is still appropriate. Not to be perpetually anxious and perpetually informed and perpetually on the verge of making a move that feels smart but statistically isn't. Anxiety is the behavior gap generating itself before you've done anything yet. Now, this is where it gets really interesting because there are 3 distinct levels of investor, and the gap between them is not intelligence. It's architecture. Level 1 is the person invested in nothing or effectively nothing, with most of their savings in a standard checking or savings account earning 1% to 2%. Inflation in 2026 is running at roughly 2.5 to 3%. A dollar in a 1% savings account in a 3% inflation environment loses roughly 2% of real purchasing power annually. Over 20 years, $100,000 in that account becomes worth approximately $67,000 in today's purchasing power. The escalator wasn't stopped. It was running in reverse. This is the median American financial situation. The Federal Reserve's Survey of Consumer Finances found that as of 2022, the median retirement account balance for Americans aged 35 to 44 was approximately $45,000. The mean was $287,000. That chasm between median and mean tells you exactly how concentrated investment wealth is in this country. Level 2 is the consistent index fund investor. Automatic monthly contributions, low expense ratios, broad diversification, long time horizon. This is the correct and complete answer for the majority of people the majority of the time. $500 a month into a total market index fund at 7% real return for 30 years produces approximately $560,000 in today's purchasing power. That's financial independence. That's the escalator doing its thing. Most people never reach level 2, not because the math is hard, but because they can't sustain the behavior through 2 or 3 scary years. Level 3 is where portfolio architecture starts producing meaningfully different outcomes. And in 2026 specifically, two things are different from what they were a decade ago. First, concentration risk inside the S&P 500. As of early 2026, the top 10 companies in the index represent approximately 35% of total market capitalization. Apple, Microsoft, Nvidia, Alphabet, Amazon, Meta, Tesla, the Magnificent Seven have driven a disproportionate share of index returns over the past 2 years. This isn't a reason to abandon index investing. It's a reason to consider a partial allocation to an equal weight S&P 500 fund or an international developed markets fund tracking the MSCI EAFE index, which covers roughly 21 developed economies outside the United States. In the 1980s, the dominant S&P 500 companies were General Electric, ExxonMobil, IBM. No one predicted they'd be dethroned. No one predicted that the phone company everyone had would become obsolete. A BlackBerry share that cost $144 in June of 2008 is worth about $4 today. The companies leading the next decade are probably not identical to the ones leading this one. Geographic and structural diversification is cheap insurance against that uncertainty. Second, fixed income is no longer inert. In 2015, a bond fund yielded essentially nothing. You held it for stability, not return. Today, a US 2-year Treasury yields approximately 4 to 4.5%. For investors within 10 years of needing their money, or investors with genuinely low risk tolerance who would panic sell an equity-heavy portfolio in a downturn, holding 20 to 30% in short duration treasuries now has real expected return attached, not just downside protection. The 2022 disaster for the classic 60-40 portfolio, down roughly 16%, its worst year in decades, was a product of starting from near zero interest rates. That starting condition is gone. The bond picture has changed structurally. Neither of these points are a market timing call. They're allocation decisions you make once and hold. Let me give you a parable that has nothing to do with stocks and everything to do with why boring wins. After the Second World War, Toyota was producing cars significantly inferior to American manufacturers. Their output was slower, less reliable, more expensive per unit. They didn't solve this with a breakthrough technology or a genius hire. They implemented a philosophy called Kaizen, which translates roughly as continuous small improvement. Every worker on the floor was empowered to identify and fix one small inefficiency in their area per day, one process improvement daily for decades. The improvements were invisible in the short term and transformative over time. By the 1980s, Toyota had built the most reliable cars in the world, not through dramatic action, through boring consistency compounded over a long enough period that the results looked like a miracle from the outside. The mathematical analogy to investing is almost one-to-one. A 1% improvement in annual net return, whether from cutting fees, fixing tax location, or reducing behavioral drag compounded over 30 years on $200,000 is worth approximately $240,000 of additional terminal wealth. 1%. The boring improvement. Nobody makes a documentary about it. The math doesn't care. The escalator goes up the same speed for everyone. Kaizen means you're riding it in a more efficient vehicle. Now, here's what nobody is telling you about the wait for a correction instinct. That is, right now, in early 2026, keeping intelligent people sitting in cash. The Shiller-Cape ratio for the S&P 500, which measures price relative to 10-year average inflation-adjusted earnings, is sitting around 35. The historical average is roughly 17. This has led a significant number of otherwise rational people to conclude that markets are overvalued and the sensible move is to wait before investing. Here's the problem with that logic. CAPE has been above its historical average for essentially the entire period since 2012. Anyone who exited the market when CAPE crossed 25 in 2012 and waited for normalization missed one of the longest sustained bull markets in modern history. CAPE is genuinely predictive of rolling 10-year average returns. It is essentially useless as a short-term market timing signal. 14 years of data on this specific question says, overvalued on CAPE does not mean about to correct. Vanguard published research in 2022 examining what happened historically when you invested a lump sum at an all-time market high versus other entry points. Investing at all-time highs produced average 12-month forward returns that were slightly better than non-all-time high entry points. The reason is mechanically simple. The index hits all-time highs, roughly 30% of all trading days. All-time highs are a normal feature of a rising market, not a warning sign. The market doesn't owe you a discount before going higher. Peter Lynch averaged 29% annual returns running Fidelity's Magellan Fund for 13 years. In the 90s, he said that more money has been lost by investors preparing for corrections than has been lost in corrections themselves. He was right then. He's more right now, when the preparation period can last a decade and be sustained by an infinite supply of convincing arguments. There's a version of this moment, early 2026, where intelligent, financially capable adults are sitting in 20 to 30% cash, waiting for the AI bubble to correct before committing. If the correction comes in 6 months, they'll look smart. If it doesn't come for 4 years, which is equally plausible, they'll have missed 4 years of compounding and still feel like they made the prudent choice. That's the trap. Prudence and paralysis have identical psychological signatures. Now, here's something your financial advisor probably never mentioned, and I want to say this carefully because it sounds more complicated than it is. Tax location is quietly worth 1 to 2% of net annual return for most investors, and almost no one does it intentionally. The principle is this: different asset classes have different tax efficiency. Stocks in broad index funds generate mostly long-term capital gains, taxed at 15 to 20% for most investors. Bonds generate interest income taxed as ordinary income, potentially 32 to 37% for higher earners. Real estate investment trusts generate non-qualified dividends, also taxed as ordinary income. The rule: hold tax-inefficient assets inside tax-deferred accounts, 401k, traditional IRA, and hold tax-efficient assets in taxable brokerage accounts. Bonds go in the 401k, REITs go in the IRA. Broad equity index funds go in the taxable account, where long-term capital gains treatment minimizes annual tax drag. This doesn't change what you own, it changes where you hold it. For a $500,000 portfolio with a 30% bond allocation managed this way, the expected annual tax saving runs somewhere between $500 and $1,200 depending on your bracket. Over 20 years at compounding, that's a meaningful sum, available to anyone with a basic understanding of account types. Almost nobody does it because almost nobody knows it exists. The escalator runs the same speed. Tax location is choosing the right pair of shoes for the ride, okay? Now let me tell you what happened to Marcus. After the 2022 bear market, where Marcus had once again partially moved to cash after re-entering at the wrong time post-COVID, and once again ridden a drawdown down, he did something I want you to pay close attention to. He got exhausted. Not motivated, exhausted. He stopped trying to be clever. He wrote a 1-page document answering 3 questions. What am I invested in? Why did I choose this allocation? And under what specific circumstances will I change it? That third question is where every investment strategy lives or dies. When the market feels scary is not a qualifying circumstance. Marcus wrote, I will change my allocation if my time horizon changes by more than 5 years, my income drops by more than 30%, or I am within 3 years of my target retirement date. Otherwise, the allocation does not change. I review it once per year on January 1st and take no other action. He set up automatic monthly contributions of $1,200 into a 3-fund portfolio, 60% US. Total market index, 30% international developed markets, 10% short-term treasury. He removed the brokerage app from his phone. He unsubscribed from every financial newsletter he'd been reading for 6 years. By early 2026, Marcus is ahead. Not because he got smarter, because he stopped intervening. His brother David, meanwhile, has been active. David made 90% in 2023 on a concentrated AI infrastructure portfolio, and then lost 60% of the entire account through 2024 and early 2025 as valuations corrected hard. David's net real return over the identical period as Marcus's boring, automated strategy, slightly negative. David had more interesting conversations. David spent more hours staring at charts. David is not ahead. David went to dinner parties and explained his thesis while Marcus went to the gym. The escalator does not care about your thesis. Let me give you the mini case study, because theory without specific numbers is just philosophy. You're 38 years old. Household income, $120,000. You have $40,000 in a 401k you haven't opened since you enrolled. $8,000 in a savings account earning 1.2%. A mortgage at 5.5%. No other debt. You want to retire at 65 with at least $1 million in today's purchasing power. Step 1. Open the 401k today and find the expense ratio on whatever fund you're in. If it's above 0.1% on a broad market fund, switch to the lowest cost index option in the plan. That action alone on $40,000 compounded for 27 years could represent between $50,000 and $150,000 of additional wealth depending on the fee gap you close. This is a 20-minute action with a 6-figure expected value. Step 2, that $8,000 in savings. For household spending $4,000 a month, a 6-month emergency fund is $24,000. You're not halfway there. Before investing a single additional dollar, you need to reach that floor. A high-yield savings account in 2026 should be paying 4 to 5%. At 1.2%, you're losing $200 to $300 per year in interest. You should be earning on money you've already saved. Open a high-yield account at any major online bank and move the money this week. Not eventually, this week. Step 3. Once the emergency fund is built, the sequence matters, and most people get it wrong. First priority, 401k contributions up to the full employer match. An employer match is an instant 100% return on your contribution, pre-tax, before the market has done anything. Nothing in finance produces that return. If you are not capturing the full match, you are declining free money to go do something else with it. Second priority, Roth IRA, up to the annual contribution limit of $7,000 in 2026. A dollar contributed to a Roth at 38 that grows to $7 at 65 exits, completely untaxed. The compounding is tax-free. On a 30-year horizon, that tax treatment is worth more than most investors realize. It effectively adds between 0.5% and 1% to your net annual return, depending on your eventual tax bracket. Third priority, back to the 401k, up to the annual maximum contribution limit. At $120,000 income, contributing roughly $900 to $1,100 monthly into tax advantage accounts gets you to the $1 million real target by 65, assuming 7% real return. That's approximately 9 to 10% of pre-tax income. Difficult, but not impossible. Now here's the number that should make you close this tab and open your brokerage account immediately. If you had started this exact same strategy at 32 instead of 38, the same $1 million target would require roughly $550 per month, not $900. Those 6 extra years of inaction don't just cost you the contributions you didn't make. They cost you the compounding on contributions you would have made. Every year of delay is a permanent reduction in terminal wealth that can only be compensated for with more money later. The math of compounding punishes delay at an accelerating rate. And one more thing before we close, because I see this pattern constantly and it makes no mathematical sense. People in their 30s and 40s paying down a mortgage at 5% aggressively while keeping investment accounts underfunded because markets feel risky. Paying down a 5% mortgage is a guaranteed 5% after-tax return. Investing in a total market index fund has an expected real return of 7% based on 100 years of data, with a long-term standard deviation that shrinks meaningfully over 20-plus year horizons. On a purely expected value basis, for money you won't need for 15 years or more, equity investing wins above a rate threshold of roughly 6 to 7% on the debt side. Below 6%, the comparison is genuinely close. Above 7%, credit card debt, personal loans pay the debt first, full stop. That calculus is not ambiguous. The escalator analogy holds even here. Paying off 5% debt and not investing is choosing a guaranteed 5% staircase over an escalator with a 100-year track record of 7%. You might arrive at the same floor. You'll arrive significantly later. 3 takeaways. Specific to this topic this year, not generic advice. 1. Audit your expense ratios this week. Every account, every fund. Find the expense ratio. Anything above 0.1% in a broad market fund is a solvable problem with a quantifiable cost you're currently paying. The switch takes 20 minutes, and the expected value of that action is measured in tens of thousands of dollars over your investment horizon. There is no excuse for paying for underperformance in a world where free outperformance is available in the same account. 2. Write an investment policy statement before the next market drawdown. 1 page. 3 questions. What do I own? Why did I choose this? And what would specifically have to be true in my life, not in the market, for me to change the allocation? Market conditions are not a qualifying change event. Your personal financial situation is. Write this document during a calm week. Keep it somewhere you'll find it when the next correction happens and financial media is screaming. Your past calm self should be making those decisions, not your present terrified self. The policy statement is not a constraint. It's the only version of you that should be managing your money. 3. If you are currently sitting in more than 15% cash waiting for the right moment to invest, run the math on what that wait is actually costing you. 7% real return. Every year you delay investing $100,000 costs you approximately $7,000 in first-year expected return alone, plus every future year of compounding on that amount. The risk of waiting is not zero. It's quantifiable, and it's running right now, silently, in the same direction as the expense ratio you haven't checked yet. Lazy investing built more fortune than crypto memes. The escalator is running. It's not exciting. It doesn't have a notification setting. It doesn't need you to pay attention to it. It just goes up. The only investors who got seriously hurt by it are the ones who kept stepping off.